Good morning, everybody. And again, Mark, thank you for having us back, and thank you for RaaS for organising the event. So fantastic here. Thank you very much. So we're going to give a short run through of May, of Q3. This is similar to we presented in our Q3 wrap up. And please look forward to questions at the end. So firstly, for those of you who don't know, we're a data company. So we have access to over 21 million people around the world, and we access those people to either ask them questions, their views, their opinions, and or we gather data from them. It's all permission based. Everybody knows they're doing it, and they get rewarded for either sharing data and or answering questions. And we do that on behalf of our clients. We have over 800 clients around the world, and those 800 clients continually want to understand their consumers, if they're political parties, their voters, governments, could be issues that are going on, B2B, etc. And really it's feeding that market research industry, the $130 billion market research industry, with answers so that we get better products, more targeted, relevant advertising, relevant content that we read. So that's what we do, and data is the new gold. So on the right hand side of this graph or table, you have platform. That's where we have all of our panels, the 21 million people. In the middle, very clever technology. We're an over 20-year-old company building technology throughout that time. And then on the left-hand side, we have clients who access either through managed services, through direct services. We have SaaS platforms that include DIY surveys, etc., or directly through APIs, so direct connectivity to all of our audience to access them and get their answers, solving their problems, answering their questions. So that's what we do fundamentally as a company. As we evolve and as the world evolves, we see, as we look to 2025 now, financial year 25, you can see the yellow boxes. So we're increasing our data points. We expect that to increase to about 50 million global people. We're adding something called synthetic data. This means that actually you can start to analyze all this data to get the answers without having to ask the questions, clients having to ask questions. So it's faster, more efficient, possibly cheaper as well, and a wider audience can access that data. And then on the left-hand side, you have new clients, which include AI clients and those big AI engines that need what's called training data so that they can give their answers to their problems for their clients. We expand from quantitative into new solutions such as qualitative solutions, and then direct to client solutions, including such things as ad effectiveness, brand track. So what I'm talking about here is new revenue streams. So we enter into new revenue streams from new products and new clients, that AI world. What's the prize? As I said, we've got global peers. The total market is worth about $130 billion. Our global peers are between 150 million Australian dollars revenue and 1 billion Australian dollars revenue. Why are they that? Because they're particularly strong in the US and the UK markets. I've said this a number of times to the viewers of this. The UK market is 11 times bigger than the Australian market, the US market 40 times bigger. And those providers also have direct to client solutions. So that's the size of the prize. Where are we? Well, in the last 4 years, we've trebled the size of our UK business. So we've got a really strong platform, over 15 people today in the UK market, a strong brand, a number of clients that have grown, a strong audience that we have access to. And really the absolute focus for us in financial year 25 is growing out that UK business. so that it's truly, we're winning market share, but it's truly representative of the size of the market. 11 times bigger than Australia. I said it's approximately 10 to $12 million business. Australia is bigger than that. It's upside down. Shouldn't be that case. And over the last 4 years, it's been a focus for us. We've done the same in the US business. We've trebled the size of the US business. We still do that through remote sales. And we're being very strategic about our investments there because it's very easy. It's a big market, very easy to spend a lot of money, not get a lot of traction and not get movement. So 25 is the absolute focus for UK, and then 26 will be the absolute focus for us as a business for the US. Also, across all markets, we're building out our solutions. Our platform revenue today has grown to 20% of our revenue. That's all of our SaaS products, all of our automated products. 4 years ago, that was practically zero. And also, as I said, identifying new client solutions so we can cross-sell clients and offer more revenue streams to our business. And as an industry, we have fantastic tailwinds. We have quality issues across the industry, verifiable, real people answering real questions, sharing real data is a challenge. It's not within Pureprofile because everything is permission-based from real people. Our peer group, that audience, the 150 million to $1 billion, again, they're having different business changes, business challenges. Might have been companies being purchased by private equity who are restructuring businesses, refinancing debt in other ones, pivoting in other ones. And that's a great opportunity for us where we're winning market share and also attracting great people to our business who want to work for a growing organization such as Pureprofile. We attract great people because we are growing, because we have great branding within the marketplace, fantastic employee and client satisfaction. So that means we're able to access fantastic people in new markets and expand. And then the last point is this rise of AI. And you need to think about AI in 3 different ways. Firstly, internal efficiencies as we roll out AI solutions to be a better, faster, more price-sensitive organization, more efficient, growing our EBITDA margins. And already we've rolled out a number of products and talked about those before, such as AI translations, the way that we analyze data, the way that we provide data to clients. That's the first group, internal efficiencies. The second one is looking at the way that we have solutions that we can deliver better to the clients, new solutions, innovation, faster innovation, and the way that we can, again, help clients to answer their questions in a better, faster, more cost-efficient way. And then the third group is looking at AI as a total entity. So that's clients, new clients that need AI or have AI training data, and they need that verifiable data from Pureprofile so that they can prime their engines to make better predictions, give better answers. And also looking at potentially Pureprofile and how can Pureprofile actually enter also into that AI engine space now with access, as I've talked about, with close to 50 million people in financial year 25. What have we achieved in the last 4 years? Well, our revenue CAGR has been 27% over 4 years to financial year 24, including our mid-range of guidance. And I'll talk about guidance in a minute. Our rest of the world revenue have an absolute strategy, which is to grow the company internationally. We've grown rest of the world revenue from 29% total revenue in financial year 20 to 43% at the March year to date. And the goal is obviously rest of the world overtakes Australia. Our EBITDA, we've had a CAGR of 57% over the 4 years to financial year 24, mid guidance again. We achieved profitability in H1 financial year 24 for the first time ever, true NPAT profitability. And 4 years ago, that was a net loss of $9.8 million. We've been operating cash flow positive for over 3 years as a company. We've grown our client rate, number of clients from 550 to 800 March year to date. We've grown our international offices from 5 to 13. Our platform revenue has grown from 0.5 million to 6.5 million March year to date. We've grown annuity revenue from 3.5 million to $10 million on a rolling 12-month basis over the last 4 years. We've enhanced our technology platform with new technology, investing in our existing technology, and then looking at new developments, SaaS developments, client connectivity, internal efficiencies, and AI. So I joined the company 4 years ago, and we had a clear strategy around 3 areas, which was 1, focus on data and insights as a company, and we've divested of our media businesses to absolutely focus on that business. 2, grow internationally, and you can see that that's been and is being achieved. And number 3, grow out our technology platforms. And again, examples like how our platform revenue has grown from 0.5 to 6.5 million shows that that is also being achieved. So diving deeper a little bit, looking at Q3. So Q3, our revenue grew 6%. It was a record Q3 for us as a business at $10.9 million. We actually had softer Australian trading environment, and listening to Pioneer Credit, it's a soft market today in Australia. That's not true in the rest of the world where we're eating into low market share, but Australia is soft trading. And so we had a soft January and February compared to prior year. But actually we saw March up 16% on PCP, so that's great, and actually that's continued, and hot off the press, our April numbers, it's 21% up on PCP, so that's really exciting, and we've seen that we've reacted and responded to the softer market with a number of initiatives and seeing that growth here in Australia. We've always seen the growth in the rest of the world. That revenue is up 11% on PCP, and again slightly boosted, especially with strong growth in the UK as we start to expand our UK business for next year. EBITDA actually declined in the quarter. We had a change of the way that the executive remuneration, it's gone from share-based payment to removal dilution to cash-based, so that's one element that affected it. But also we had several operating expenses or several investments that were higher. This is due to higher staff expenses. We opened up a German, Spanish offices, so there's higher expenditure within there, which gives us growth outside of ANZ, and also some higher technology expenses, rolling out ISO 27001 accreditation that gives us access to government projects that we hadn't previously been able to do, so that's really exciting. And again, we'll see that come back in the remainder of the year. As I talked about, Australia market picked up to 1% growth, rest of the world again 11% growth, and platform is still at approximately double growth per quarter at $2 million. I talked about this a little bit, but as we look at ANZ revenue specifically, that's 16% over a 3-year CAGR, rest of the world 34% over a 3-year CAGR, platform revenue 124% over a 3-year CAGR, and 8% a 3-year CAGR for EBITDA, looking at all those metrics, looking at Q3. When we look at full year, March year revenue actually increased 7% PCP, and again growth in outside of Australia up 18% on prior years. Highlights strong growth we had in Q3 following a flat year revenue. So when we reported half year, it was flat year, and now that's grown to 7% year over year. Our EBITDA down 10% on PCP, but again we had that change around the executive remuneration, so actually if we exclude that we would have been up 2% on previous year, and again we now have almost zero dilution from any equity plans, so that's something that we have done, we're asked to, and that was something that's fed to for shareholders. Our key priorities for Q4, as we're well into that now, we're halfway through that. So it's returning that Australian business to strong growth in both revenue and profitability. And I touched on what we've already seen for April. Carrying on our international expansion growth, growing our data and panelist growth. So we're set up for a strong financial year 25. Ensuring that all of those final internal AI solutions and other internal technology enhancements are finished so that we fully see the EBITDA margin expansion, we fully see the benefit in financial year 25. Maintaining that NPAT profitability that we saw for the first time ever in the half year, and that's a focus to maintain that for the full year. And then as we look to financial year 25, it's ensuring we have the right teams and the right investment in place to really see that international growth continue and even accelerate and maintain that growth in Australia. We also revised our financial guidance. It was broader before, it's 46 to 51 million. We're able to hone that down to see revenue guidance of 48 to 49 million. And again, EBITDA margin was previously 3.2 million to 4.6 million. We're able to hone that down now to 4.1 to 4.5 million. So good growth in both elements for us as a business, and reaffirming that guidance that we released firstly at our AGM, and actually being able to have stronger, tighter guidelines around that. So in summary, we had record continuing business for our Q3 revenue, despite those challenging trading conditions we saw in Australia. We've seen an absolute recovery in trading conditions, with March being up 16%. And as I said, hot off the press, April was up 21%. Our international business continues to grow faster than the ANZ growth rate, which is absolutely right as we eat into that market share that we don't have. We also have a broad refresh underway, strengthening our board with areas around industry experience, and that should be completed at the end of this month. We're aiming for. Process been underway now for five or so weeks, so we're very excited about that. And then finish the year strongly, achieve our guidance, implement the actions, ensure we deliver shareholder value for this year and moving forward. And with that, I will hand back to you, Mark.
Thanks, Martin. And I'll just remind everyone the last RaaS research update note encompassing all those Q3 numbers that Martin was talking about. I've shared in the chat if anybody wants to download it. But let's kick off with a few questions. Martin, just on the UK market, you say it's 11 times, greater than the Australian market, but I mean, it's not 11 times the population. So why is the UK market, so much bigger? Is it just a more mature market? Is it, big American brands have their European office running out of London, and they're sucking work that might necessarily be happening in Germany, but they do it through the London team? Like, why is it so much larger than Australia, given you haven't got such a massive population difference?
It is exactly your last point, Mark. You should be in our business. So it is that out of the UK, it is a hub for Europe and international work. And so you see a large amount of international work. Up to about 40% of the market research, data and insights work that's done in the UK is actually international work. And that's very, very different to Australia, where you see 80 to 90% of all work in Australia is actually domestic work, not international work. So it's the economy is that much bigger in the UK, and then it's the international work that adds that additional layer in. And again, Pureprofile, one, we have offices across Europe now, but in addition to that, we also have panels and we have data access across all of Europe. So we are conducting all of that international work already from our UK base.
And I just talk about the platform business for a minute. In terms of how that compares to, you know, the rest of the business, just in terms of, you know, cost of goods sold and margins, I'm guessing it's, you know, much more of a, you know, a SaaS-like business or more of a technology type business rather than, you know, a lot of the more, I guess, labor intensive, even with, you know, a lot of technology behind it. There's still a lot more bodies involved in the rest of the business rather than platform business. Would that be fair to say?
That again, absolutely fair to say, Mark. So today, about 20% of our revenue comes from all of our platform products, and we have 4 or so platform products or SaaS products and automation that sits in that platform revenue line, and 80% comes from managed service. So you're quite right. As we expand that platform level, then our managed services reduce, our overheads reduce, our fixed overheads. Already, a lot of our overheads, we have about 100 people in India and the Philippines, like more, it's about 110 people in India and Philippines. Amazing team, do a fantastic job. But again, what we're able to do is then expand without adding further to that team. And so as you've seen our EBITDA margin expansion, and I think 4 years ago it was about 3%, and it's expanding through the 4 years. That is in part due to what we do with platforms. So it's faster, there's more automation, takes less people, and actually also it adds to a higher quality point because you've got a peer-to-peer, point-to-point direct access for a client. So there are less hands in between the handling of that data.
Question from the audience here, Martin. Let me just take this one. How do you, this is actually a good one. How do you acquire your audience you survey on behalf of clients, and what is your growth rate for acquiring audience?
Yeah, that's a really good question. So we acquire audiences in 3 ways. So the first way is we directly go out and we recruit audiences. And that might be by advertising on Google or Facebook or through affiliate networks. So we directly advertise. And so that comes into our audience, and we have our own panels around the world that we can build out. And we're putting our hand in our own pocket to recruit people that then do surveys or share their data. The second way that we do it, and it's a little bit of our secret sauce, so hopefully we haven't got any competitors listening, and we have a product called Audience Builder. And what Audience Builder does is it plugs directly into large loyalty schemes. So here in Australia, a partner that we have a number of partners. One we have is Flybuys. So if you go to the Flybuys app today, you can actually, and you go to a section that calls earning Flybuys points, you can actually do surveys to earn Flybuys points. So we have Flybuys members who do surveys, and in real time they earn Flybuys points that go into their Flybuys wallet that then they can spend within the network. So the advantage of that is it enables us to build fast audience, large audience really quickly and without putting our hand in our pocket. And we do a back-end revenue share with all of those partners. So the benefit is quick revenue streams for us, haven't asked spend any money. And the benefit for the partners is higher engagement because their members earn their points or their loyalty scheme by doing something else. They get lots of data and insights, which is what they want to do because they want to understand their consumers better, to upsell, cross-sell, etc. And then thirdly, the revenue share. And then the third way that we get our members is actually we rent the missing people. So we might do a study, let's say, for example, in Orange, or nationally, we're doing a study, let's say, on electric vehicle owners, and they want 100 electric vehicle owners in Orange, and we might in our own network have 95 electric vehicle owners in Orange. And so we actually go out to our network and we bring in the missing 5, ask them the same questions or ask for their data and share their data, and then away they go. And broadly speaking, if it's our own members, it's around about a 70 to 80% margin. If it's through our audience builder partners, then it's broadly around a 60% margin to our business. And if we're renting and letting go, it's about a 30% margin. So beneficial to have our own members, but we're putting our hand in our own pocket when we could be making investments elsewhere. So that enables us to revenue share with the audience builder.
And then I just wanted to go back to, you mentioned your peers in the industry, they're doing that kind of 150 million to a billion in revenue, but I think you said the overall market is like 130 billion dollars. So it seems like it's quite fragmented. If you've got, the largest players are only doing a billion in a 130 billion dollar market. What's happening from a kind of M&A industry consolidation point of view? Is that happening, and how does that impact Pureprofile in terms of some of your competitors getting bigger, and at the end of the day it's all about who's got the best data and the largest volume of data, I think, in this game.
Yeah, so a really good question. There are M&A opportunities. As an organization, as a company, we need to be really cautious about that. Our market cap is very low at the moment, so it doesn't enable us to go out and make acquisitions. YouGov, Y-O-U-G-O-V, they're listed on the UK stock market. They just made an acquisition of audiences across Europe, and they spent 330 million euros on that acquisition. So clearly there's top end of town. Where we're looking at the moment is firstly, we can grow organically and carry on growing organically and carry on growing into that market share, low market share that we have, with a better service offering, better quality, and exporting everything that we do well in Australia. But also over the last few years, we've now built up a little bit of a balance sheet, and it perhaps enables us to look at small bolt-on acquisitions that maybe give us some small versions of Pureprofile that give us a little bit more data, maybe a little bit of software, and it gives us some acceleration into markets that we're already being absolutely focused on. So this isn't big acquisitions that move us in a separate direction, but small ones. And yes, certainly there are some opportunities of those. We look at those very carefully, and really under three criteria, which is, number one, it needs to be profitable. The business absolutely has to be profitable. Number two, it cannot be dilutive to us as an organization. When we look to us as a business today, and our trading ratios as they alter, or our KPIs as they alter. And then thirdly, it needs to be key to our strategy, and it offers some sort of growth on our strategy. So we look through that lens. It means we reject a lot, but then we investigate some others. So it gives us small opportunity, Mark, as you said, for some bolt-ons with our current balance sheet.